Good evening to everyone. This is Dr. D. Katika, Department of Commerce with Computer Applications, Dr. College of Arts and Science. Today we are going to discuss about the corporate tax, that is your accrual of income and receipt of income regarding your corporate tax. So in your accrual of income, in corporate taxations, the concept of the receipt of income and accrual are crucial for determining when income is recognized for the tax purposes, because the receipt of income, it may be received in the future, but this particular income we not receive in our present. Say for example interest, so that interest it will be received in the future but not now, but it will reflect your income. So the receipt of income, it's of the income accrual of income, it is again categorized into three types. One is your receipt of income, another one is your physical receipt, another one is your constructive receipt. So the receipt of income refers to the actual physical or constructive receipt of the income, and this physical receipt, this is when the company receives cash or its equivalent such as bank deposit, that is your physical receipt. Then constructive receipt, this occurs when the income is available to the company even if it has not physically received it. So for example, if the customer's payment is credited to the company's account but remains uncashed, it may still be considered received. And then next is regarding your tax implications regarding your income. For certain purposes, the types of income, that is the receipt method, might be used for tax purposes, particularly in cash accounting system. In your income tax filing, this income recognized on a receipt basis may be taxed in the financial year in which it is received, irrespective of when it is earned. So we are getting a clear picture that the income earned in the financial year is going to be filed. Next one regarding your accrual of income. So as I told earlier, the accrual of income, it has been received or not. Under the accrual base of accounting, income is recognized at the time it is earned and realizable. And then accrued income, this income include that has been earned but not received. That is interest income that accumulated but has not been received. Then matching principle, under the accrual accounting, the revenues and related expenses are matched in the period in which they occur, providing a more accurate picture of the financial performance. Then this is regarding your recognition, income tax filing, accrual of income and accrued income, and then matching principle. Then next regarding your that is recognition in your tax implications. The tax purpose, it might be, once again, sorry, it has been repeated. Next is regarding your comparison and application in your corporate tax. So as we are discussing about your corporate tax, we have a comparison with your corporate tax. So corporate tax under the accrual basis. So what happens, corporations generally follow the accrual basis of accounting for financial reporting and tax purposes. This means they must recognize income when it is earned, even if it has not been received. So when it is received in the financial year, it has to be updated in that particular financial year. If it is going to be received in the future, then automatically it has to be shown only in the future. Then expenses, similarly the expenses are recorded when incurred, not when paid. Then corporate tax under the receipt basis, cash based accounting. Say for example, some smaller businesses or specific tax regimes might use a cash based accounting system where income is recognized when received and expenses are recognized when paid. So this is less common for large corporations but may be applicable in certain cases. So I am given here practical examples regarding your service contracts. If a company provides a service in March but receives payment in the April, under the accrual basis, the revenue would be recognized in March, the month the service was provided. Then again, interest income. If a company earns interest income over several months but receives the payment at the end of the year, the income should be accrued monthly and reported accordingly, even though the actual receipt occurs later. So regarding your regulatory framework in India, under your Income Tax Act 1961, Indian tax laws generally require companies to follow the accrual basis of accounting for tax purposes. And regarding your section 145, This section of the Act allows companies to adopt either the accrual basis or the cash basis of accounting, but once adopted, it should be consistently applied. Then accounting standards, the Financial Accounting Standard FAS and the Indian Accounting Standards IAS, it has been also generally require companies to follow the accrual basis of accounting, aligning the financial reporting with the tax reporting. So in conclusion, the distinction between the receipt and accrual of income is essential in your corporate tax accounting. So receipt focuses on when the income is actually received, while accrual focuses on the income is earned. I repeat, the receipt focuses on the income is actually received, then while the accrual focuses on the income earned when it is earned. Corporations typically use the accrual basis of accounting to ensure accurate financial reporting and compliance with tax laws. However, the specific treatment of income may vary based on the accounting policies adopted and applicable regarding the regulatory requirements. Okay, thank you for listening to the corporate tax web series which I given to you. Again, you can kindly keep in touch and follow my series. Thank you.
Thank you.